Welcome back to the channel. We are going to take a look at the Fed today. Oh, 1 second. Okay, that was not supposed to happen. All right. Anyways, we are back to the channel. Let me turn this off real quick. All right, cool. So it's because we basically try to connect Instagram. StreamYard finally, opened it up to Instagram, and yeah, we're gonna try to stream on Instagram. Anyways, we're going to talk about we're going to go over the Fed, right? So we had this big move on Wednesday, and I think a lot of people are still confused on why this move happened for the S&P 500, right? Stocks, crypto didn't react as much, but the bond market and stocks really started to move. Here's the bond market on that day. Pretty pretty large upside, and forgive me, my still trying to recover. My voice is, it comes in and goes out, but we're going to get through this because I think this is very important for investors or anybody trying to educate themselves on the market going forward, on understanding how the Fed works, how the market interprets the Fed, and what we're going to see going forward. So let's dive into it. So anyways, we have the S&P here. We'll focus on that and look at how we had this gigantic move. This was mid-meeting, by the way, mid-Fed meeting. And pretty much this is what we saw when it came to the bears covered in, they pretty much look like this. Yeah, that was the extent of the bears. They got crushed. And going forward, the market had that big upside move and now pretty much headed for all-time highs. So if we drop to the, the 1-day chart, you can see that the S&P broke the summer highs, right? We broke the summer highs, and the Dow actually made all-time highs. So this line right here is the all-time high for the Dow. We actually, broken all-time highs for the Dow. Apple's at all-time highs, biggest stock in the market. And yeah, so I wanted to go over that a little bit, and we're going to listen to a couple clips. There's three main clips here. There's about 3 main clips here that I wanted to go over for the Fed that kind of highlights why the market interpreted, Powell, or while the market interpreted Powell being so dovish or bullish for the market. And we're going to go over the SEP, which is the summary of economic projections. And really, the market started moving before Powell even spoke. They moved before Powell spoke. And that's simply because all the writing inside of all the writing that they had before the market, or before he spoke, pretty much outlined that they're done hiking, that the war on inflation is over. And that's what the market wanted to see. And a lot of shorts had to cover during that meeting. So I think what we'll do is we'll start with let's just start with the meeting. We'll interpret the meeting, then we'll go over the SEP. That was the main data for the Fed that they put out. You can see it if you go to the Fed website. So we'll go over that. But first, let's check out this clip. And excuse me, this is one clip on the Fed. Actually, let me see. Let's go to, yeah, we'll stick on here. We'll just check out this clip, and then we'll go over kind of what is going on here.
If the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal that there's a belief of weakness next year in the economy?
It could just be a sign that the economy is normalizing and it doesn't need the tight policy.
How sticky is core inflation right now?
We've seen real progress in core inflation. All 3 of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing.
So the Fed basically said, if we do cut rates, right, it's not because the way we're looking at things right now, if we do cut rates, it's not because there's a deep recession. They're not seeing that in the base case. If they cut rates, it'd be because of a normalized economy, which means inflation is coming down. So they asked them about core. Core is coming down in all 3 segments, which is huge, meaning that was the war they're fighting, right? Now that is being resolved, a lot of people will tell you, oh, the Fed can only cut rates if the economy collapses or we go into a deep recession. And I'd argue we had that event happen in March, the banking crisis, but the Fed actually stepped in. They've been stimulating, right? So for the most part, Powell communicated, hey, we're actually going to cut if we do, because the economy is normalizing, not because of any, big drop in growth. We're not seeing that happen. The economy, GDP is very strong. So dipping over to the actual, let's just look at the chart that they highlighted here for everybody. And if you want to look at this, this will be on my Twitter. And it is part of the summary of economic projections. It's a lot of data, so that's why I want to I mean, it's kind of confusing data, so I want to kind of go over what it looks like, how you interpret it. So this is for, excuse me, this is Q4 of 2023, and you're basically seeing the change in GDP right here, right? This is the change. Don't worry about 24, 25, 26. That's just longer term. This is what they see. These are the changes that they're seeing in GDP, unemployment, the labor market, and basically headline inflation, core inflation, and then what they're going to do with the rates, right? So here's the change that they saw in this meeting versus September, right? September, October, November. So 2 months later, they actually see, okay, GDP is actually set to increase. And that's why he's saying, hey, we're not really seeing the slowdown that everybody expected, right? The economy, all the economists were wrong. They were all wrong. All the bears were wrong. We didn't see it. And there's a lot of reasons for that. If you ask the questions, or if you have any concerns, we'll go over that. But GDP actually increased versus expectations for the Fed. So the market's like, okay, yeah, we're stronger. And a lot of people say, oh, well, that's negative because it spurts inflation. No, because there's, supply chains are normalized, unemployment unchanged. So they don't really see a change in unemployment. And remember, unemployment is at record, is at historic lows right now. We're at 3.7, and it looks like we're going to end 2023 with a strong labor market, right? Unless some black swan event, we're going to end it with a strong labor market, and we'll go over why that is. Also, you're having inflation drop significantly. So from September, and this is kind of what it looks like, 2.8 was, or I'm sorry, 3.3 was September. And now 2 months later, they're like, okay, our inflation projections for year end are actually lower. They're below 3%. And, that really caught the bears off sides, or the people who are, calling for recession or higher inflation. It's not happening. PCE core inflation, well, inflation's coming down. So it dropped 50 basis points, which is a pretty big drop. That's a pretty big drop over 2 months, right? Core inflation, what they focus on, a lot of that is services, right? Because we know manufacturing's been in recession. Services and shelter, stuff like that, they're seeing a drop from 3.7 to 3.2. So you're getting closer to that normalized 2 to 3% historically in inflation for their projections, which means, and this is why this is bullish, that they're not going to keep rates as high as they need. As long as inflation falls, their policy actually becomes tighter, and that pushes you closer to recession. So they don't want a recession, and if inflation drops, we don't need a recession. If it doesn't drop, then they have to keep tightening or allowing the rates to play themselves into the economy, and that gets you closer to recession. But the fact that inflation is dropping, they can ease up on their rates, right, going forward. So their interest rate projection for year end was, on average, this is median, by the way, was 5.6 2 months ago. Now it's 5.4. So that's one rate cut. That's essentially one rate cut at the end of the year. It doesn't mean they're going to cut this year. It just means, okay, you know what? We're not going to hike, basically, because the year is pretty much done. So what does this mean? The conclusion here is strong growth. Basically, they communicated, we're seeing stronger growth than expected and lower inflation, which is Goldilocks. That's the perfect scenario for the stock market. And that's simply why the market exploded in the intraday and got above all-time highs for the Dow. Even the bond market was going up a lot because we're seeing weaker inflation, higher growth. That's a perfect scenario, right? If you're thinking about 4 seasons, how you plant a seed, well, this is spring. This is where things start to spurt again, right? The market is looking at, good growth and low inflation, springtime, then you go into summertime. And we're no longer in the cold bear market, right? It's just not there anymore. So that's sort of that. Now the next clip, let's check out this next clip and then we'll interpret it for you guys. Let me check your comments really quick. What up? $400 clone. Keep up the good work. Appreciate it. Yeah, I just wanted to throw it out here. I know I've been gone for a while. I've been sick, and then I recover, and then my voice disappears again. So hopefully this is done by the end of this month, and we can get back to streaming pretty much 5 days a week, right? 5 days a week. Shout out to you. And Instagram, this is the first time, so you guys might be new on here, but we go over the economics, the macro economy. We go over the fundamentals of the market, earnings, right? All the earnings, and we go over technicals at the end. So we'll save your tickers for the end. I'm probably going to go over Tesla and crypto. All right. So back to it. Next one, next video. This is about 25 seconds. Is growth a problem? So basically the Fed is looking at 3 cuts. I don't think maybe we didn't see that one. Let's check this out. Watch. I want to show you guys the 3 cuts pretty much that they're pricing in here. All right. So here's what they're looking at. So this is 2024 before that next part. lower GDP. So they're actually looking at 2024 GDP coming lower, or the economy slowing, not as fast as it was in 2023. Okay. So slower GDP, no change in unemployment, lower inflation still, because if inflation's already falling in high growth, it's going to be much lower when growth slows in 2024 as they project, right? Lower core, whatever. So much lower interest rates is what they're seeing. Their projection for 2024 was that they'd be at 5.1, right? And we're at 5.5 right now. So they would still be lowering it, but now they're looking at 4.6. So if you take 5.4, right, which is where they're at in 2023, because we're at 5.4 median, 5.5, 5.4. These are median, so it's not like exactly the rate. It's all the 12 members voting where they see it. So the median was 5.4, and now they're looking at 4.6, right? Much lower interest rates. That's 80 basis points or 3 cuts, right? So 25 basis point cuts. That's where if you're seeing this in the news, 3 cuts in 2024, it just means that they're expecting to cut 3 times because the economy is normalizing, not so much that the economy is falling apart. They don't have to cut because of an emergency. They're cutting because inflation is falling, and they see growth lower in 2024. So that next clip is growth a problem, is what they're asking. Well, if growth accelerates, is that going to, because a lot of people are saying, well, stronger economy means they're going to keep rates higher for longer, and higher for longer is very subjective. Higher could be that they just keep it there, not that they hike, or it could be that they don't cut all the way to 2%, or cut all 2%. They just cut maybe a little bit, right? So is growth actually a problem? Is that next? And if growth is a problem, it's bad, right? But if it's not a problem, that means the economy grows, it expands, stock earnings continue to rise while the Fed cuts rates and increases valuations, right? Because if you cut rates, you're going to have more growth, period.
If growth were to surprise us again by being stronger than expected, would it still be possible to cut rates? Put another way, would continued progress on inflation alone be sufficient?
If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%.
Is above trend growth itself a problem?
It's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals.
So growth might keep them from hiking fast. And this next chart. Growth isn't necessarily a problem unless, it's not really a problem at all for them, meaning they're not going to increase rates or hold rates. They're going to keep cutting. Now here's oh, you know what? I messed up. I didn't show it on there. I just posted it right now on the chart. So this is kind of the chart. They're projected, this is 2024 here. They're projecting to be cutting rates, right? So this is their inflation projection for PCE, 3.7, 2.6 next year. They're expecting 2.6. So a lot of people are bearish because they think, oh, they won't cut until we're at 2%. But what the Fed is saying is, no, we're going to cut as long as inflation comes down. So you're seeing that in their projections, their SEP, 2.6 next year, 2.3 2025, 2% 2026 is when they're pretty much done cutting. That's where they want inflation to be at, right? Before they stop cutting, or they keep, we'll see how the economy goes. The point here is they're going to be cutting. Here's 5.4, 4.6, 3.6, 2.9. So they're cutting along the way inflation falls. So they're saying here is, as inflation falls, we're going to cut. It's not, we don't cut until 2%. We're cutting on the way to 2%. So as we make progress, we will cut to keep the restrictive level where it is, right? Because if inflation falls, actually, the Fed rate hikes become more restrictive. It's a bigger, because you're keeping rates high and growth is slowing. You don't want to do that because it's basically pushing growth lower. So if you cut rates, you're keeping, while inflation falls, you're keeping that level of restriction pretty much even with the economy, right? So they're going to cut along the way. The Fed will cut and they're going to cut to sustain growth. They don't want to just wait because then they'll crush growth, right? So they want to cut to sustain growth. And as inflation falls, if it doesn't fall, then they won't cut. It's as simple as that. All right. Last video basically solidifies this last part of the SEP, which is, are you going to cut before 2%? So this is Powell's words saying, hey, we're going to cut into 2%. We're not going to cut at 2%. We're going to be cutting on the way.
How much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. I mean, you'd want to be reducing restriction on the economy well before 2%, so you don't overshoot.
right? So they want to cut, as we show, as the SCP shows here. They don't want to overshoot because inflation's a lagging indicator, which means if they wait till 2% right here, then that's looking backwards. So really, the next month it's going to be dropping to negative. It's going to go to 1.5. You don't want that because that means growth. One thing to understand here fundamentally is that growth is driven by debt growth. Growth is driven by inflation to some degree. Inflation is not terrible. It's only bad when it gets above a certain level because it's stimulative to the economy, right? If you want your wages to go up over time, that's part of inflation. If you want things to grow, you run a business, well, your price is going up over time with the money supply means your business grows, right? Higher prices. So really, if you look back every 4 years, prices don't go down. They don't really stay the same. They climb a little bit. The problem is they've been climbing fast. Now that's slowing down. So so basically, they're going to cut along the way, and that's simply because they want to sustain growth. So the Fed will be cutting. Well, I don't know if they will be exactly, but they're saying, hey, we're going to cut. And the market loved that information. Why? Because the market's biggest fear is from the last meeting was that the Fed would not cut rates the whole 2024. So look at how big this changes. They went from not cutting rates at all, okay, keeping it up here. So 2024, they were at 5.1 median, but they did say, hey, we're not going to cut it all. And now they're at 4.6, right? Well, actually, you can look at September. They were at 5.6 in September. This is confusing, but I'll just interpret it. They were at 5.6. So where they're at today, 5.5, 5.6, same thing. And now their median is 4.6. So from here to 2024, you're looking at 3 cuts. Before there was none. There's pretty much no cuts. That's what they said anyway. So the market is now pricing in, lower cost to run businesses, lower costs. That's more liquidity. That's more retained earnings into the economy, and that's more retained earnings into profit margin. So you're gonna see that start to take place there. So excuse me. So the next part I wanted to focus on there is basically, so we went over the Fed, right? Let me see if I have this up here. The Fed, and we're going to go over actual inflation so you can see how that's actually playing itself out, right? So the Fed, we saw the Fed. What are they saying? They're saying, hey, we're actually going to cut. We're going to do 3 rate cuts. We're going to cut into 2024. So our target might not hit till 2025, but we're going to cut along the way. Very positive as inflation comes down, as growth reaccelerates. Now, actual inflation, and if you're curious to why they can keep cutting and why growth can maintain, it's because a lot of inflation isn't just demand. Everybody thinks is very false that inflation goes up if the Fed prints. Inflation goes up if just if there's more money in the system. That's not how it works. From 2013, right, the Fed increased the Fed's balance sheet. They printed a lot of money all the way to 2019. We had no above trend inflation. We didn't have over 3% inflation. Why? Because our supply chains were good, meaning the more supply you put onto the market, it absorbs inflation. It absorbs inflation. It absorbs excess demand, right? And if you can produce more things, then prices don't have to go higher. And what do we get? Better supply chains. This is one chart. The supply chain pressure is down, meaning things can move faster through the economy. They can get delivered faster. Inflation doesn't build up. And if there's more people coming in, the labor force participation rate is up pre-pandemic highs, back to pre-pandemic highs. So more people are participating. A lot of that is due, ironically, to immigration. Is it legal immigration? Probably not. But more people coming into the economy, working at a lower price, lowers wage inflation, right? And you're producing more. Plus, the big boom was AI. Artificial intelligence is producing more on the software side, more so producing more services without increasing costs because you can cut your labor hours, right? You can get rid of people, replace them. Oh, I don't like that. Well, what do you want? Pick your poison. Do you want higher inflation or do you want the same jobs? You're getting different jobs coming into the market while other jobs start to fall, but inflation comes down. Prices are what people typically hate, and we see gas prices are starting to plummet now because the supply chains are fixed, because more productivity is taking place in the economy, and we're getting a lot of growth. I should be live on Instagram. It's new, and I don't know if it went through. It should have went through, so maybe it didn't work. I'll figure it out. But this is live, so I don't want to like sit there and mess with it. I just want to go through. I'll fix it. All right. So the next segment here is let's see what I had up there for. Okay, so oh yeah, inflation, and then we'll go over inflation and the actual soft landing, right? So here's what we're looking at for when it comes to inflation. You have two segments: producer prices, that is in the green, right, or the teal. Producer prices. Remember, the normalized level going back is like 2.5%, 2.5, 3%. That's a normal level. Well, we did spike. This was, during the expansion period where we had excess demand and broken supply chains. So prices went up. Now PPI almost went negative. It bounced up a little bit. It's at 0.85. There's no inflation. There's no producer price inflation. What does this say? That for producers, they have to put in, it costs them less to run their businesses in aggregate, in whole, and they can retain more earnings. That's why profit margins for the S&P 500 right here are starting to rise into 2024, because markets are forward looking. They look into the future. So earning estimates are up, not solely just because of PPI, but that's one factor, right? If you're paying less to grow, you're retaining more earnings. So earnings are higher. And then the actual inflation rate, CPI for consumers, it is higher than producers, but it's led by the producer prices. We're at 3.12. And we're not, we're falling. It's rolling over. A lot of that is due to oil prices and gasoline prices. Those are energy prices. We're still pretty elevated in shelter when it comes to single family homes, but rents are falling. If you look on a map, if you go on Zillow, and it depends what region you're in, a lot of rents are falling. A lot of multi-family housing is falling. A lot of real estate is falling. That's why the real estate market's frozen, because they cannot increase prices anymore. Prices have to fall. There's not enough demand. There's not enough supply. Supply should be coming in now. And here's another tricky part when it comes to real estate. The Fed is telling us, think about this. The Fed is saying, hey, we're going to cut 3 times. So what happens to the home builders? They're saying, okay, we anticipate lower rates. That's going to stimulate growth. So they start building more supply of single family homes, anticipating that lower rates is going to cause, or basically create more demand. So we should see more supply come into the housing market, which actually pushes prices lower. And I think that's the trick here for the Fed that they're trying to execute, is if we can, maybe if we lower rates in 2023, or at least tell them, communicate that, then housing will come down because we get more supply. All right. Now, economic momentum here. So that's inflation. Inflation's coming down. The war is over on inflation. Economic momentum, right? This is basically ISM, or forward-looking growth. Just call it services and manufacturing momentum. Well, services never went negative. Services momentum has been positive the whole time. I do think we get a slowdown in February, March, April, because the consumer spends the most in what? October, November, December, seasonality, right? Seasonal jobs, a lot of holidays, a lot of travel, a lot of people have time off of work, they spend more money. But here come January, that's going to slow. February, I think we really slow because a lot of those seasonal jobs come off, and services might dip a little bit, but we'll keep our eye on that. On the other side, the ISM manufacturing momentum is starting to pick up again, right? Led by new orders. So if we do get this, oh, you know what? And these are ISM new orders on both sides. So the new orders are the furthest forward-looking indicators you have for the economy. They're economic momentum indicators, and momentum is picking up underneath the hood, right? We're getting that pickup underneath the hood. And a lot of that is also due to global liquidity picking up. So this is year-on-year money supply coming from the biggest central bank. So you're talking the Federal Reserve, the Bank of Japan, the Public Bank of China, the European Central Bank, and the ECB. Oh, no, that's the European Central Bank, and the Bank of England. So if you aggregate all the biggest central banks, money supply has been rising for a while, when the market bottomed somewhere in October, it's been bottoming since. So as we go into the slower period of growth in the projections of 2024, remember they're slower. Well, liquidity comes into the market. There's more fiscal and there's more monetary stimulus coming in, which is why we see Bitcoin going higher. We see gold going higher, because they are front running this money supply coming into the system that hits capital markets first. So that's sort of why economic momentum is actually picking up going forward, and we should see that continue, right? Getting back to the soft landing, that is actually part of the soft landing. That is part of the soft landing here. And I have Bitcoin at the bottom because it's still the best performing asset from COVID, from 2020. It was at 4K. We're up 10x, right? There's not another asset class up 10x from 4 years ago. Or yeah, it's about 4 years now. It's coming up on 4 years. We're still up 10x. And I hear people say crypto is not in a good state. Isn't that when you want to buy it? Would you buy a house when the price is high or low? Would you buy a new pair of shoes or any type of computer device or cell phone when it's on sale or when it's expensive? So crypto is rising. It's up 10, Bitcoin's up 10x, right? From 2020. NASDAQ is not up that much. Neither is S&P, neither are bonds, neither is gold, nothing else. So Bitcoin is still moving higher. But point being, going back to it, why is it? Let's take a step back. Why are we seeing this? And I'll explain this out. Why did we have a soft landing in 2023, right? Pretty simple here. We had massive fiscal stimulus, and I don't know why nobody talked about this, but this was why the bull market started in October of 2022. We had over $1.5 trillion of fiscal policy, and it didn't all come at once, but it's slowly coming into the system. The Inflation Reduction Act, is it inflationary? It is to some degree, but while growth is falling and you start pumping fiscal stimulus, right? Building manufacturing plants or supporting electric vehicles, supporting different types of energy, you're building. Manufacturing picks up, right? And there's a whole lot of stuff that goes up with that. You have the CHIPS Act, also semiconductors, right? The war for new technologies, China invading Taiwan. That whole narrative is about getting more chips, right? Because there's a Cold War for AI. There's a Cold War for better technology, and that starts with transistors, which really have been now chips. So so chip manufacturing is going up. They have a TSM plant here in Phoenix. They've been building a lot of apartments too. So that's part of the infrastructure bill. But a lot of this CHIPS Act is to build the new technologies into the future. And when you add these all up, it's over $1.5 trillion. It's probably more than this, to be honest with you. And that should roll into 2027. So we're going to get massive fiscal stimulus from the government spending through the next couple of years. Next, shadow QE. Although they told you that we're in QT, where the Fed is tightening rates and the Fed is, pulling money out of the system. That is true. But we also had shadow QE, which is this program. And I think this was really the trump card for the Fed. The reverse repo facility was a facility where you could stack cash and get paid interest on it at the Fed. Well, that money has started leaving the Fed in 2022, coming back into the capital markets, which provides liquidity for the treasury market, for the bond market, which is more support for the government to keep spending. So simply put, the government, and here it is, RRP cash left the Fed and it all absorbed the fiscal debt. So all the debt that was created from the US was absorbed by this repo facility, right? That provided liquidity to bond market, ultimately spending for the government. So that's why these this massive fiscal, these bills are getting supported by really the Fed, right? So all that cash is coming back in. You're going to see more spending. I think we get that in somewhere around the summertime. It's an election year, right? And then here's really the strong labor market. Everybody thought, oh, we're going to have a recession, and you get a recession by three things. Economic activity goes negative. Well, ISM manufacturing did go negative. Services never did. So you got a rolling recession there. Some things were in recession. Housing, manufacturing for a while. Services were still strong. And then two is GDP. We didn't see negative GDP. We got stronger GDP in 2023, above trend growth, right? And then you had immigration, like I said, and he talked about this in the meeting. It's like 45 minutes, so I didn't point it out, but he said immigration was stronger than we thought. Automation came online. So when you automate things, you create more growth, higher productivity. And if a robot can do the job of 5 people, or AI or some type of software, then you're going to create more. You're going to increase the supply of workers, because that still technology counts as a worker. Obviously it doesn't get paid, but it's cheaper for businesses. So automation lowered the pressure for the labor pressure, while creating more growth. The gig economy, right? Jobs have been falling all year. Jobs growth has been falling, but it doesn't count a lot of the gig work, right? A lot of the Uber drivers, a lot of the social media gigs online. And, I always say OnlyFans. The exploding business there. It's worth, I don't know how many billions of dollars. Those people are not on payroll. So you're not going to see that show up on the payroll data. So growth is happening underneath the hood. And then you also have the boomer wealth transfer, right? The boomers own like $60 trillion. They've been spending on services the whole time. And we're going to see the biggest wealth transfer over the next 4 years as the baby boomers retire, as they, they're done, they're ending. A lot of them, they're dying off, and that wealth is going to be transferred over. So last part of the soft landing, we just talked about this. Economic momentum indicators, the ISM services never contracted. It never went negative. Services are 80% of the economy. They never went, or about 70% of the economy. They never went negative. So you never got that recessionary, you never get that those recession conditions for services. And new orders for the manufacturing sector started to reaccelerate due to the fiscal policy supported by shadow QE. And then global liquidity started to reaccelerate, led by China and Japan. There's some other countries, but mostly China, Japan have been increasing the Fed. They've been printing money. They've been stimulating a whole lot there, right? So that's why we had the soft landing. And let's see, what else am I missing here? That's why we did have that soft landing. And going into Q4, we just saw, right? This is supposed to be a slow quarter, but all that spending, what did we get? We got record spending for Black Friday online sales. And then Cyber Monday was huge. So early in December, GDP growth for the fourth quarter was at 1.2%. That more than doubled now, according to the Fed GDP Nowcast, which tracks real-time consumption. That doubled. So now we're looking at stronger growth for the fourth quarter. These numbers don't come out till this Friday. I believe this coming Friday, or maybe it's sometime at the end of the week, and we're going to see how much stronger GDP really is to end 2023, right? And then 2024 we should slow, and we'll go over that chart. And unemployment, right? Unemployment's going to rise. It just hasn't rose. It hasn't. There wasn't a rise. There wasn't a real rise in unemployment. We bottomed down here in January of 2022. And it's just been moving sideways. It got a little lower in September. That's when the market bottomed, the stock market bottomed. And we've just kind of, initial jobless claims, which are the most leading labor market unemployment data indicator, hasn't really moved much. So people have jobs and they're finding jobs, immigration, more jobs. People are just not filing massively for, and I know people are saying, well, Q1, right? Commercial real estate. But what happened in March? In March, we had a banking crisis and the Fed stepped in, plugged all the holes. I expect the same thing to happen if we do get a real estate collapse. And it's not going to be a major collapse. It'll be small because as the Fed starts to cut rates, well, that's going to ease pressure on the commercial real estate sector. And there's a whole lot of pent up demand. So some people lose and some people win. That's just how markets work. So jobless claims are not rising, so unemployment probably stays below. They have unemployment at 4.1%. That's still pretty low. If you spike to 5, you're in trouble. That's still pretty low, right? And let's see if we finish earnings. Oh yeah, we didn't even go over earnings. So earnings, here's the forward-looking PEs. You're probably not. I know this is kind of different, but this is, if you ever hear about PE or multiple expansions, right? Multiples. What is that? It's just price to earnings. So the price of the whole S&P 500 divided by earnings. If you look 12 months ahead and the PE ratio is higher, then it's telling you that earnings are going to grow. So basically, as this rises, it's projecting higher earnings growth. If we look at it in another way, right? Earning estimates have been accelerating for the S&P 500. Okay. Now, other individual stocks like Nvidia, Amazon, Apple, Meta, their earnings estimates are exploding. A lot of them. Tesla is struggling a little bit, but now that rates are getting cut, I think you see Tesla start to rise again too. Another way to look at it is just the entire what is this, earnings growth? Yeah, earnings growth going into 2024. You can see that it's rising all the way till Q2. So even if the economy slows a little bit, companies, the best companies in the world, they can still grow their earnings because they can cut costs. They can use AI to replace workers. And it's unfortunate if you lose your job, but there's always another job somewhere. You just have to adapt. That's how the world works. And let's go to profit margin. So top line is pure revenue, right? But if you go to bottom line, which are profit margin, so after all your costs in the S&P, how much earnings are you actually retaining? This is what investors want to see. This is where big money actually wants to see. It doesn't matter if you're a retail investor, you want to see where the big money's headed, and big money has now gotten the signal that profit margins are rising. They've been rising for about 3 or 4 quarters now, and they're set to they're set to expand. They're set to expand even further. And this is all we won't get there yet. All the cash on the sideline. We're not going to get to that yet. But there's a lot of cash on the sideline, which is why we saw that insane rip this past week. We saw that insane rip simply because all the fears of the market are disappearing. They're evaporating. They're not totally gone yet, but it looks like the Fed is pretty much done. And here's the thing, when it comes to markets, right? And this is more so correlated to risk assets. So equities, big tech, mega cap tech, crypto, whatever it is, the cycle is turning. We've been calling this for a while. And these are the three biggest macro forces you want to look at here, which are borrowing costs. You can use the 10-year treasury yield this is basically the rate of interest for the market, not necessarily the Fed funds rate, but the rate of interest for the entire market. And this is what's been moving markets. As it goes higher, it's increasing rates or reducing the earnings, profit margins of companies and making it harder to borrow money. But now they've been falling significantly. So as borrowing costs fall, because growth is set to slow in Q1, Q2 of 2024, because the consumer will slow down in January, February, March. Maybe they start picking up again. We'll see. But borrowing costs come down. So that chases growth. As growth falls, borrowing costs falls. That eases financial conditions, stocks go higher. As energy costs fall, right? Everybody thought, oil was going to 100, 150, didn't happen. And simply because Saudi Arabia and OPEC, they're losing market share. The more they cut, right? The more that they cut production, that might make prices go up a little bit, but they're also losing market share long-term to other non-OPEC countries. And they don't want to keep losing market share. I actually expect to flush down to 60 into Q1 or Q2, because OPEC, they did this before. They're going to increase their production so they can gain back their market share, produce more at lower prices. And that will flush energy prices lower as demand comes down in aggregate, right? And the last one is the dollar. So this is an all easing of financial conditions. The dollar is that other big one, and global trade cost, right? Typically when the dollar falls, markets go higher. This is when the S&P actually bottomed back here when the dollar peaked. So the dollar is a huge inverse correlation to the stock market, not one for one, about 80% of the time. If it moves sideways, stocks move higher, risk assets move higher. If it moves down, they move higher faster. So you're getting full financial condition easing, the fastest easings I think in like 50 years. And that's going to set lower rates, lower energy cost, lower trade costs. That's going to increase margins, increase a lot of the performance of risk assets in general. So now let's take a picture at what we're seeing going forward here. This is what, did I have a commentary there? Yeah. So this is what I expect. This is ISM new orders. So this is economic momentum. If there's one indicator you had to look at for the economy, where's it headed, right? Not where it's at, where it's headed. GDP looks backwards. You want to look at new orders, ISM new orders, supply chain managers looking into the future. And what they're saying here, or what's going on, is in green above 50, you're in expansion territory. Well, ISM's been contracting. This is the rolling recession that we've seen, right? A lot of slow growth in the manufacturing sector, but construction is going higher because of onshoring from fiscal policy. Onshoring, bringing more, manufacturing jobs into the U.S. to build chips, to build electric vehicle technology, to build new types of energy, whatever it is. That's been keeping the manufacturing sector for new orders from falling apart. So those are going higher. And what am I missing here? Also, construction for multifamily homes. Although the housing market's been frozen, multifamily has been exploded. We've had the highest spike in multifamily builds in history over the past 3 months, 3 to 6 months. So that's also bringing this up. So once it starts to expand, that's it. I mean, there's no stopping the economy in the bull market once you start to expand here. And this has been driven by productivity growth, not just debt. Productivity, more workers, more bang for your buck. And that's the best type of growth because it absorbs inflationary pressures, right? So I think somewhere in February, April, we see a slowdown for the consumer, okay? Because you guys are not buying Christmas gifts anymore, right? You're basically, oh, let's get back to the gym. Let's be a little more disciplined. This is the American economy anyways. And yeah, you have Valentine's Day. I doubt people spend too much. Their credit card debt is still still pretty high. So they get more relieved once you head into January because they have to pay back their debt. So I expect consumer spending to slow January. You get the January numbers in February. So that's where I think the market starts to peak out. I think stocks go pretty bullish all the way till the end of January, early February. and they slow down, that's also earnings season too. Now, stocks are, what they've been doing is either bidding up into earnings and then selling off midway, or selling off into earnings and then bidding back up halfway through earnings. So I think we go into earnings strong and then we sell off. We move sideways February, March, possibly April. Maybe stocks are pretty resilient. They might move up ahead of that. And then it all depends on when this election stimulus comes. And we're already, when I say that, if the consumer gets too weak in between February and April, February, March, April, May, if the consumer weakens too much, I mean, the one way you buy votes in the White House is you print money, right? Biden has the lowest approval rating of his entire, presidency. And I expect more stimulus. He's already trying to do it. So just look out for the news. You're going to see that the market's going to like it. Is it inflationary? No, because productivity can absorb inflation. Supply chains are strong. Supply chains are absorbing a lot of the demand coming into the market. You're not getting a whole lot of demand. And artificial intelligence and automation helps that out. So yeah, I think by the end of the summer, we start to rebound again. And the real question is, where's inflation? If inflation keeps falling at the pace it is, by summertime, inflation will hit the target. The Fed may have already done a hike, a cut or two, maybe one, maybe two, but they'll really start cutting rates summertime if inflation gets back to where it was. And basically, you get a soft landing. So election stimulus is the next catalyst for that the market will be looking into. Do you bet on it? Not really, but everything's sort of coming together at once. Everything's coming together. So earnings are going higher. Inflation is done. The Fed is done. They're looking at rate cuts. Financial conditions are starting to ease now. GDP is actually being revised up. The employment numbers. I mean, the labor market is still strong. That's the backbone of the economy. That doesn't just include workers either. That includes automation. If you have automation, that's more labor for a much cheaper cost, and they can work without 24/7. So that's basically what the Fed did. The Fed basically said, hey, we're going to cut rates next year because the economy is normalizing, not because there's some type of recession. And that's what I'm expecting. We'll go over the technicals next. So are we going into normalization? Yes, sir, Bukowski. I think we are headed into normalization. We have one more bump, and that's Q1 to Q2. I think that's our last bump. No recession in 2024. Heck no. I've been saying this for a while, and I'm going to keep saying it. There's no sign of recession so far. There's just no sign of recession. The consumer continues to be resilient. Baby boomers spend a lot of money. They have 60 trillion in assets, in dividend income, and money market fund income. You got to think about the richest people. They go out and they go to restaurants, they go out and eat, they travel. Well, there needs to be more labor supply in order to meet that demand. So there is a lot of hiring done. Immigration is helping that out. So they're spending, and it's going into the economy, period. While, the Fed, now shadow QE will run out, I think March or April. That's why I think it's going to get tricky somewhere between February, March, April. It might get a little, maybe the S&P goes all-time highs and then we have a nasty rip lower. That's a possibility, because there is a lot of uncertainty in Q1, but it's not a bear market uncertainty. It's not recessionary. It's just a slowing, right? It's just a slowing of the economy, a cooling of growth. But check out the ISM new orders. ISM new orders, if they do start to get an expansion territory, then that script basically flips, and the market goes higher despite a slow economy. So you could see, I think that's a big possibility, is that we do get that. And when it comes to, Bitcoin in general, this is basically the cycles you have. You have that 1 year of, let's go back a little bit. Bitcoin is in the sweet spot, right? We're in crypto spring right now. And looking at the cycles, you have crypto spring, crypto summer, and then fall is when it peaks out. And then you go into crypto winter, right? Same thing here. And these are, I think this was a 50x, and then you had 100x, something like that. 100x. Bitcoin went from 169 to 4,000. No, 25,000, my bad. Or 20,000. Is this going to happen again, this type of magnitude? No, but it's the fastest growing asset on the planet at the size that it is. So crypto winter, crypto spring, crypto summer, crypto fall, that's where it peaks. Crypto winter, well, we just left crypto winter, right? We're in crypto spring. We're in early spring. And yeah, we're in early spring. And as the Fed starts to cut rates and, print more money, crypto is going to go ballistic, especially with the demand coming into crypto, right? The ETF has to be passed by January 10th. I mean, it's like a 99% probability that creates insane demand for Bitcoin. There's a lot of career risk for fund managers. If they don't catch the cycle, they get fired, right? They have to perform. And when the best performing asset starts to move, they're going to pile in, which is where you get these gigantic moves to the upside. Also, the Bitcoin supply gets cut in half in, I think, May of 2024. So right about when I think you get fiscal stimulus from the White House, the ISM turns positive, the Bitcoin supply cuts in half, and the economy starts to rebound. Is when Bitcoin it's a great setup for crypto in general, and we should see, Bitcoin. I think conservatively it goes to 150. I think it might go to 250 on this cycle, right? Depending on how rapid that expansion is for the manufacturing ISM and the stimulus and the election cycle, right? Do we get tax cuts? Is there going to be tax cuts? If we get tax cuts into the election, a lot of promises of tax cuts, which there's going to be a huge debate. I mean, the biggest factor is the economy all the time in elections, and everybody's going to be bidding to how do we increase the economy. So they're going to make promises, and I think assets are going to definitely pose a lot of potential there, a lot of potential to see that happen, right? So your biggest risk is still oil spiking. I don't see it happening. I think OPEC comes in and flushes the market, and while demand is low, you just don't get any inflation, and it's not going to just come back roaring out of nowhere, right? So that's what I see for Bitcoin. Now the tech stocks, they broke out of this wedge and they are testing all-time highs, right? We're now testing all-time highs for the Qs. There's a lot of people who argue it's not a bull market till you get to all-time highs. Well, what are they going to do? They're going to have to flip bullish while the market gets to all-time highs. There's a lot of shorts up here. May take a couple pushes. What do we have? GDP next week. We have GDP. We have PCE data. What do we have? GDP on Thursday. GDP growth rate. We have core PCE, so the Fed's preferred inflation gauge. We might get down to 2.9, possibly 2.9. I mean, we'll see how if we drops that far, it's going to create more bullishness. Then we have ISM January 3rd. I think that's going to be huge. If the ISM contracts, we might sell off early if the ISM starts to contract. Because that's the most forward-looking growth indicator. Right now, we're expecting higher growth. We're expecting more growth, or it'll just confirm that growth is slower in Q1. So I'm looking for the ISM. Everything else is pretty predictable. The ISM, I don't know. We'll see how that plays out. But right now, yeah, that's what we're looking at. And if we, dive down a little closer, right, we have that big rip higher on the Fed. So your resistance in the short term is, I think we're starting to support that resistance. So here's the peak that we had. This is the peak we had after the Fed meeting. We peaked out at 403, or I think the SPX like 40. Where's the SPX at? SPX is at 47. Goodness sake, 4,700. Oh, that's the Qs. My bad. Let's go to SPX really quick. So SPX this was the Fed meeting. We had that gap up after the meeting. And you can see we're just clearly supporting the Fed meeting level. It might slip a little bit. Could slip, but that's our support at the moment, is the Fed meeting. And yeah, we're forming a pretty bullish pattern here. You have try to break out, but you have a little wedge here forming. So very bullish. Very bullish. So what gets the market higher? Well, again, as better than expected numbers come in, you have to keep in mind that there's a lot of leverage that has not been in the market, and that leverage should be coming in. Here's margin leverage for the S&P 500, FINRA margin debt ratio. At the lows, at the bottom, you have less leverage, and we're at the lows. So I expect this, as we hit all-time highs, that leverage to start coming back into the system. And you have a lot of money market fund cash coming back into the system. Yields are down, and I think yields just keep falling. Maybe they move sideways. Moving sideways isn't bad. So if we get that, then this is very positive for S&P going forward. The VIX is at, I mean, shoot, the VIX is literally signaling, secular bull market or back to just a grind, a slow melt up higher, right? VIX is at 12. Historically, when the VIX is this low, go to that monthly chart. When the VIX is this low, you're in a bull market, right? It's when you spike up here. I mean, this is a lot of data, but basically when you get to this level, let's go 2016, after the crisis in 2016, the VIX came down to like 8 or 9 into 2017. This was the tax cuts, right? More fiscal. So we're getting a lot of fiscal. I know people get pissed when the White House spends money, but you got to take your politics out of it. As long as they spend money, the economy is supported. As long as productivity picks up, you can absorb all the demand, all the inflation, and technology takes over. Also, technology is very deflationary at the same time. Triple B spreads are pretty good. A lot of people are buying debt. HYG, this is very bullish. And the indices are up a lot. So let me see, semiconductors, all-time highs. Home builders are back. This is crazy. This is also a really good way to this is a good proxy to what's happening. These are US home construction. This is the US home construction ETF. And it's always forward looking. Markets are forward looking. When Powell said, "Hey, we're going to cut 3 times," or our projections, our SEP projections are 3 rate cuts, what does that mean? That means more building for the home builders, because okay, now we can get that rate pressure off the commercial real estate, well, residential real estate, multifamily, whatever. We can take some of that pressure off because people will come back into the market. They'll start refinancing, start building, whatever. So the home builder ETF is signaling a recovery for the housing market. And it might not be your housing market, but in aggregate, in macro, that is what that's signaling there for the home builder ETF ITB. And then small caps too. A lot of people believe small caps will be the best performers going forward. And it's probably true, right? If rates are coming down, if inflation has peaked, then you get a lot of the businesses that have to refinance. They're gonna, all that fear of refinancing at a higher rate is starting to dissipate. So what does that mean? That means if we break out of this, the bigger the consolidation, the bigger the breakout, we could see IWM or small caps rise significantly, right? Back to 230. This is a catch-up trade. So we're at 200 pretty much. Remember, everybody thought, oh, this is a leading indicator. Well, now it's leading up. So, man, that's a big move for an ETF. A lot of the individual stocks in here, I'm not too privy to a lot of them, but small caps look pretty good going forward also. Small caps look pretty good. And of course, I'm just going to go over Tesla because this is what I'm trading Tesla at the moment. So I'm taking a look here. This is probably the best, in my view, this is probably the best mega cap setup, bar none, not even close. Everybody else except for Amazon has pretty much caught up. Tesla's been trending higher, making higher lows, higher highs, right? So, oh man, why do I always use that brush? So here's the bottom. And basically our margin's done going down. Well, if the Fed is cutting in 2023 or 2024, that means interest rates should be coming down as inflation makes progress. And the motor vehicle business, right? Most people, the demand falls because rates are too high. It just costs too much to buy a vehicle. So if rates are coming down, forward looking, markets don't wait until something happens. They're anticipating it, which is why the Fed communicates ahead of time. Well, higher lows, right? And then higher highs. Well, here's the low, higher high, higher low, higher high, higher low. So that next move should retest 300, 320, somewhere around there. And And then, man, all-time highs are like 4 something, and it doesn't take much. There could be a gigantic short squeeze. Tesla, by market cap, has the most shorts in the market, meaning there's the most potential for a short squeeze when it comes to Tesla, the mega caps. And it is knocking on the door to break out of this 250 level. As long as it holds 250, it's sort of in a range. Let's go to this chart. It's sort of in a range here. It's been in this range for a while. So 250, yeah, it's been in this range right here. Say this is resistance and your support's down here, but I mean, it's forming a triangle pattern, a bullish triangle. It's been knocking on this level for a while, and it can short squeeze pretty quickly. So we'll see if it gaps up. We'll see if it gaps up on Monday. Well, tomorrow we'll see if it gaps up above 253. I think is the level. Let's go back to this. Yeah, we've been knocking on this level for a while. It could pull back down and consolidate a little more, but 254. Once you get above 254 and it holds, if you see that sharp move away from price on Tesla and it forms a wedge pattern, I mean, that's it. It's over. The pressure, the volume's coming in. Breakout traders step in, shorts start to cover. It already filled that gap, and you have a lot of longs coming in. Plus, a lot of the other EV makers are struggling. They're shutting down their production while Tesla's increasing production. I'm looking at Tesla with both. Yeah, everybody's watching Tesla. Everybody is watching Tesla. I mean, this is a massive. If we just take a step back to the monthly chart, right? You can see that it's getting ready. Like the RSI is still low on the monthly chart. So this trend is just starting to get up, just starting to reaccelerate. And now, like I said, the macro is poised to go higher. The fundamentals are poised to go higher. Cybertruck did a lot of damage. Not damage, but it did a lot of it bring a lot of eyeballs to the Tesla franchise, and people hate it and people love it, but that's good. It's advertising. They're starting to advertise a little more too. So that way, you can't see the wedge here, but there is a wedge or a bull flag, a gigantic bull flag. I call this a dragon bull flag because it's like a dragon. It comes up and then you see the mouth. These are powerful, very powerful breakout areas. Right. So if it breaks out, the measured move should take us. I think it takes us, first to 300. Maybe we consolidate. It could just rip right through. It depends on where the Qs are at. Maybe it doesn't go to all-time highs till the summertime, but for sure, I think over the next month, I think it's going to go to 300. And so I'm eyeing this for sure. And it just depends on, it has a lot of news coming out, but it's been stepping higher. It's breaking out of this trend. If we turn on the moving averages, it's now above all the moving averages. And they've been, they're kind of coming together. I should have Bollinger Bands on there. I don't have the Bollinger Bands, but it's looking pretty good. So I definitely like Tesla as a macro trade, as a more month out, 2 month out trade, not a day trade, more of a swing trade. I think it's the best mega cap swing trade. I know there's a lot of stocks, but the options are really good when it comes to that. Now on the crypto side, you guys already know, if you're familiar with what I'm looking at, Bitcoin's pulling back a little bit. Finally, Bitcoin could rip back down to like 38, 37K for sure. But I'm keeping my eye on Chainlink here. I'm keeping my eye on Chainlink. You got support at 13. If it does come down, probably comes down to 13, but this has a lot of potential. Oh, what are we doing? No wonder we're not on the log chart. That's why it looked weird the whole time. Right. So Chainlink is moving, and I think it has the most reach of all crypto as far as use case. I'm not saying it moves the most, but I think it's very underrated still. There's not a whole lot of supply in there of Chainlink. And Chainlink to Ethereum pulling back a little bit. Broke that downtrend, pulling back a little bit. Link to Bitcoin, same thing, pulling back. So once it starts catching some steam versus XRP, it's up a lot. Once it starts catching some steam, that's it. Solana's probably the only thing that I think in the top 10 that could outpace Chainlink, but I'm gonna go with Chainlink versus Solana. It's smaller, has a bigger use case. Swift network, DTCC, major financial institutions coming on chain, and they need to use Chainlink in order to actually come on chain. The whole financial system is coming on chain, and the only way that they can connect is by using the Chainlink technology. So again, we talk about that use case. I think it's the biggest opportunity I've ever seen for an investment, and you just sit on it. You don't do nothing stupid. You don't go crazy. But the market impact is insurance, supply chain, identity management, energy, healthcare, gaming. It goes into everything because it's bringing a verifiable web, or it's actually supporting a new web, just like we had Web 1, Web 2, Web 3, social media, now a verifiable web to verify, especially with AI and a lot of deep fakes. You need things to be more verified in this new world. So the Chainlink use case brings the whole financial system on chain, including economic activity, the tokenization of all real world assets, bonds, stocks, equity stocks, real estate, whatever it is. And it's even bigger, tokenization of all value in general. If you can tokenize anything, carbon credits, man, that use case for Chainlink goes higher. And you have also the model too. So, and people are staking on it too. People are already locking in their staking on Chainlink. I'm not staking. I'm not interested yet. It's too risky for me because I want to just trade the cycle. So I'm watching the ISM. Anyways, you got any questions, concerns before we dial out here? I'll try to be a little more consistent this week. Like I said, I've been sick and in and out. Still building the course to deliver pretty much all the knowledge that I've accrued over the past 6 years. Everything that I've pretty much accrued, making it simple, understandable. And then obviously we do lives. Hopefully we can be a little more consistent with those lives, make them better. But if you have any questions about the Fed, about macro, about fundamentals, or you have any tickers you want me to look at, let me know. I'll give it a couple minutes if you guys want to look at those tickers. Yeah, total crypto market is ripping too. The bond market is starting to pick up a lot. Wow. And I still think bonds go high. Man, that is a huge upside move. Remember, we called this out. We said, hey, this is bullish divergence. It's starting to go higher. Bill Ackman covered his position. So as long as growth, this is a really great setup too. I think the market could be much higher because as growth does slow, that just puts bonds up higher. That's just going to cause more acceleration for bonds. People want to get that fixed income. It's a fixed income asset, and it gets value. It gets a underlying collateral value as it rises. So you're getting two ways of value there. And as bonds go up, rates come down, risk assets go higher. So this is going to drag rates up as people pile into this bond trade, or they cover the shorts that the shorts are covering. Then you get lower rates, period, right? Lower rates. So the dollar too, I think, is becoming more important than rates now, because rates are set to fall because the Fed already said we're done. We're pretty much done. There's, we got to get a major surprise for anything. Fed is pretty much done. But if there's any type of scare, it'll be going into the dollar, right? And then the dollar starts to rise again. But even if the dollar moves sideways, it's not going to hurt the stock market. It would just be bad if there was, some type of growth collapse. But again, Joe Biden's in the White House, more stimulus. The Fed steps in, more stimulus. They can cut rates. They have a big cushion to cushion pretty much anything at this point. You're looking at Tesla with both eyes. I'll be looking at it early in the morning too. When it comes to Tesla, I'll be looking at it early. Let's see what we might get. Let's see what we could possibly get in the morning here. If it does gap up, if Tesla does gap up, I don't know if it runs. There's two things that Tesla probably does in the morning, and I'll finish off with this. It doesn't look like we have any questions, concerns, or comments. But if we do gap up early, let's go to that 15-minute chart. Couple scenarios here. Obviously, this is a huge resistance level at 254. 250, let's just call it 254, 255, 254, 255, right? Big resistance level. We either gap up. So let's say we open here, and what you want to see is a down move early. You want to see an early down move for Tesla. Oops. Or this is just typically the pattern that Tesla shows when it does gap up. So I think this, if it shoots up first, it could just come down all day, fill the gap, right? Fill the gap. Man, that would be a pretty big gap up too. Probably fills the gap back down. Where did it close the gap at? Could close the gap, sell off back down to 253, and then start to come up, right? Maybe it finishes over VWAP, and then the next day it starts to rise again. Or it gaps up and it immediately sells off. That's bullish. If it immediately sells off, it's probably going to do something like this and then just start ripping. Start ripping, may get above, may not. But that's what I'm anticipating, a gap up. If it doesn't, if it gaps down, then you just stay patient. You're going to get a lower price. If it gaps down, say it gaps down to 252, right? Again, you're probably going to want to see that first move lower and then go up because people are taking profits and then everybody comes in. So those are the scenarios for Tesla. Anyways, thanks for joining. I appreciate you guys. I'm going to try to right now, if you're on TikTok, I am suspended on TikTok. I'm going to try to not to get suspended going forward from here, but I'll be posting on Twitter and I'll still be on YouTube Live trying to get that consistent time. I'll get a consistent time eventually, right? So we can go over everything. But for now, there's a lot of stuff going on and I'm trying to get healthier, trying to get stop being sick here. And when I get my voice on, then we'll have a little more energy. But yeah, keep an eye on Tesla tomorrow. If you are looking at that, I'll be looking at it. I'll evaluate it tomorrow. And other than that, you guys stay blessed. Okay, eat healthy, lift some weights, stay blessed, learn something new, and just stay up to date. Hit that notification, hit the likes if you don't mind, and I'll catch you guys next time. Appreciate it. Stay blessed. Thank you.